So we are going to begin. Welcome to Master Trader's Option Trading Education Series. I'm Dan Gibby, Chief Option Strategist. And in today's webinar, we're going to cover the very important topic of how and when to use covered calls and shorting new credit spreads for monthly profit. The benefits of attending today. Regardless of what type of trader you are, what I'm going to show you today is going to help you generate more profits. How's that for clarity and simplicity? You're going to learn why and how to begin trading these strategies, and they're just going to turbocharge your returns greater than trading the stocks alone, whether you're a trader or investor. And as a bonus at the end, I'm going to show you how to get our brand new ebook called Sell Credit Spreads with the Charts for Monthly Income. I'm actually going to give you two ebooks, believe it or not. I'm going to give you also one on covered calls, which we're going to be covering the first part of this webinar. But this ebook is going to give you the flexibility to begin generating monthly returns easier than you ever imagined. And they're so easy to put on and manage that you can do them with a full-time job. They don't take a lot of time. So stick around to the end and you'll get more in-depth information on this high probability strategy. This is our outline of how we're going to attack today and cover this awesome information. So it's a step-by-step strategy for selling covered calls. And it's not going to be selling covered calls on day one. We're going to be covering when to leg into a covered call on your existing positions so that you can increase your monthly returns using the charts. The Master Trader Edge and why we favor selling options. There's a mathematical reason why we do that, and we use them we time the entry with the charts. We're going to show you the actual technical setups that we use when we're looking to enter these, either selling a covered call or putting on one of these bull or bear call spreads. So I'm going to show you just a very simple flavors of these charts showing reversal points. And then I'm going to be giving you plenty of examples on everything we're covering today. So what about me? I've been in the market since the early 1990s. My expertise is both in starting with technical analysis and then going to the option world to pick the best directional or income strategy for to mirror my expectation of the underlying. But I've been actively trading, so finding somebody like us to be your mentor is going to streamline your learning process, to get you quicker to the unconscious competence level of mastery. I've managed option layover programs, and I'm going to show you the exact tools that we use in doing that for a global proprietary trading firm. Greg and I represent hedge funds, high net worth individuals, and I'm going to show you today again what we do to help them produce those superior results. But in a nutshell, my specialty is helping investors and traders obtain better results with incorporating options into their trading arsenal. So my business partner, Greg, and I, he's just a master technician. That's who I learned from in the 1990s. We formed Master Trader together, and we trade, we consult, we educate, and we succeed very well together. And our mission and goal is for you to be part of the family so we can help you accomplish your goals. Our obligatory disclaimer. And it's really common sense. Any speculative venture that you undertake with the hope of generating, superior returns from that involves risk. So we're putting money on the line, putting on a trade, and there's risk involved. It can go against you. But everything we do when we teach is calculated, managed risk. So we plan the trade, we enter it, we execute it, and then we're in management mode in between. But the SEC wanted us to remind you of that. Start with just basic calls, call options. What are they and who trades them? So if you were to buy a call option, you're paying money, and that gives you the right to buy something. You know, we refer to that as the underlying, but it's going to be a stock in this case within a specified period of time. So options have an expiration date. Now, the call seller puts that money in his or her pocket, and then they're agreeing to sell you what you want, the stock in this case, at an agreed upon price if you want to buy it within the expiration period. So very simply, that's what a call option is and why people buy them and why they sell them. The money that the call seller gets is 100% profit the second it's deposited into his account. We're next going to get into covered calls, and you're going to see with many examples that just keeps lowering your cost basis, which is, you know, your break even. And you'll see that I refer to that as the cushion to be wrong, meaning the amount of money you take in when you sell the calls, the position can go against you that amount, and you're still at break even. But the examples are coming up shortly. Selling calls against your position, by definition, gives you a higher probability of profit than just buying the stock alone. I will show you that. The only slight downside is you're capping your potential gains. Why? Because as you see in bullet number 2, we're agreeing to sell our stock. And I just call it merchandise. We're agreeing to sell our merchandise at a specified price. And if it goes way above that amount, you've capped your gains. But I'm going to show you that we're using charts for proper timing. And that drastically reduces that small, ridiculous fear. And I call it ridiculous because you're going to see the extra return that you're generating month by month dwarfs the returns of going into hope mode and swinging for the fences and thinking that the stock's going to go up forever. Stocks don't go up forever. They go up, down, and sideways. What is this curve? We call it a time decay curve. So on the last slide, we said that call buyers, when they buy these options, they're paying money for that right to buy something. So the money that they're paying depreciates over time into expiration. And that's what this time decay curve is. And, you know, for you Greeks out there that want to, well, option Greeks, not people trading from Greece, the option Greek is called theta. So if you were to pull up your option software and you see a column that says theta, and you're like, what the heck is that? This is what it is. It's measuring the rate that the call option loses value over time into expiration. 85% of people who buy options, calls, or puts, they expire worthless. So we like to be the house, so to speak, like the house in referring to the casino. We want to be the house where we're winning 85% of the time. So the time decay to the call buyer hurts them. But that harm, decay to the buyer, is our income. I'll show you that. Time decay, and it's not linear. So, if you buy an option for, $30, it's not losing $1 every single day. It decays more rapidly into expiration, as this chart shows you. So this is, 90 days, 60, 30, 0. The sweet spot, we like selling shorter term options because look at this curve. It's falling off the cliff at a faster rate the closer you get to expiration. So we specialize in selling options 30 days or less because the income to us, the option seller, is the greatest. These are the patterns that we're looking for when we're selling call options. So whether you own the underlying stock, so whatever is your flavor, it could be, Facebook, Google, General Electric, whatever it is. These are the patterns that we're going to be looking for, and we're looking for a stall in momentum or some short-term type of reversal or breakdown. And if you own the stock, this is when we're going to want to sell an out-of-the-money call option against it. And I'll show you the pictures are worth 1,000 words. We're kind of just going through the foundation right now. But I'm just showing you on the stick charts here, this is where we're going to be, all these red lines are showing where we're going to sell a call. The call buyer is giving us money that we're putting in our pocket. And our intent is for the stock to continue to go sideways or pull back a little bit. So the call expires worthless, meaning that's our 100% profit. First example, Amazon here. And I'm going to go through the, just the FANG stocks because we have some clients who are in these and, people like to watch them. So do we. These blue stars that I'm going to be showing you in all these examples are using technical analysis and signaling to us as a chart reader the proper time to sell call options on. Let's go through some numbers. So this is what Amazon looked like as of this day. This last star right here, I'm picking up right here. So this was the day that we were shorting out of the money calls. And I'll explain what out of the money means right here. And as you can see, the stock continued to sell off. This is my option quote screen where the stock is trading, which I typed it in here for you, $14.97. So at the money means the closest strike price to that. So that would be $14.97.50. Anything over that amount is what's called out of the money, meaning it has no intrinsic value right now because why would I want the right to buy Amazon at $1,600 when I can just go to the marketplace and buy it at $14.97? So it has no value other than the piece of paper giving you the right to buy it in the future. Let's continue. We use the charts, and this was our indication, big bearish engulfing bar. Here, I'll just go back to here. So it broke out, it failed, lower high, lower low, bearish engulfing. It's time to strike. So I then go to my option quote tables and I say, what strike price would I be willing to allow a call buyer to buy my stock, and how much am I going to get paid for it? Well, it's not like you have to go looking for an individual because we have an option market. So we look at the pattern and we say, where do we think that this stock is not going to go back over in the next few weeks so we can put some money in our pocket? And I'm just eyeballing this. How about 1600? With a big bearish engulfing like this, do you really think it's going to turn around and negate this big bar and go right back to 1600? Our bet was no. So let's see what we can get paid for it. Here's my bid and the ask. And 24 DTE means I'm giving the call buyer the right to buy my Amazon stock at $1,600 anytime in the next 24 days. Just call me up and say, I want to buy your stock. But nobody's going to call you up to buy it at 1600 when it's trading below 1600. Let's continue. So the quote, I had to go back to get these quotes, so they're kind of spready right now, when I pull them up on the Thinkorswim platform. So $17 by 1885. And we always try to get the midpoint in there, so that's the assumption I'm going to make throughout these slides. So right into the close on this day, if we sell a $1,600 call that expires in 24 days, we put $17.90 a share in our pocket. So if you have 100 shares of Amazon, you sell one contract, $1,790 is immediately deposited into your account. Let's do the math on that. $17.90 divided by the current stock price of $14.97 is 1.2%. So think about that, ladies and gentlemen. You're in Amazon for a long-term hold, and you're agreeing to let somebody buy your stock, merchandise, trading at $14.97 for over $100 more. Sometimes I deliberately talk slow because I want it to sink in. I'm typically a fast talker because I get excited. So I got to force myself to slow down. So you're agreeing to sell it for $103 higher. And I still make an additional 1.2% for 24 days. And then you can look at these quotes here, and we teach you in our seminars. I can't do it now, or we'd be here 8 hours, of how you determine which strike price to pick and what expiration to take. These are, they should be per your trading plan, but we teach you how to do that. Next example, shop. Now my red star here means we aren't as confident that it's a top to sell the call out for a month. So I just put a note here that says, hey, if you see a red star, you might consider selling a 1 or 2 week out option that expires. And then the blue star is, we think it's a short-term top, so you can go out, 30, anywhere 25, 30 days, you should be fine. Now, same as we did on Amazon, this star is where we sold the call. And let's look at the math on this one. Again, I'm just eyeballing it here. So if the stock is here at 145 and change, and so I am willing to sell a call option 29 days to expiration, agreeing to sell my shop, SHOP shares at $155 a share. Look at the quotes here, $3.20 by 360, and that's per share. So if you owned 1,000 shares of this and sold 10 of these call contracts, $3,400 hits your account. And that is pure profit to you. And you see the additional reduction of return on capital in 29 days, 2.3%. Annualize this. Assume that's 30 days. Multiply this number by 12. And that is the amazing additional return you are getting by selling these calls. We look, we're very specific when we sell these, but it broke this support. It had a breakout failure, and then it traded under this low. Now we have the confidence to say, hey, Mr. Call Buyer, I will gladly enter into a contract with you for you to buy my shares at 155. But just like the other example, so I'm leaving these quotes here for you. You might say, well, I don't want to agree to sell it at 155, but I will agree to sell it at 160 for $2.20. Nothing wrong with that. You might say, well, I'm not as piggish. I'll agree to sell it at $150 a share. And then more money gets deposited into your account. So these are the trade-offs we help you learn in our course. Netflix, a bearish engulfing after a breakout. So that's not a break. It's another form of breakout failure that we teach. Do we want it? And that's why it's red. It's bearish. I don't know if he'll get his C legs back and just go sideways and then make a new high. So we would do a short-term legging into a covered call there. Now at this blue, I have a lower low. Now this makes a very ugly kind of lower pivot high. And I just put the math over here. I'm not going to show you all the detailed quotes on every one. So into the close right here is $300 and change. Way the heck over here, $340. That's $39 higher that you're agreeing to sell your Netflix for 24 days. And you're bringing in $5.90 a share. On a 10 lot, almost $6,000 goes into your account. 2% extra a month. That's just mind-boggling. You multiply 2% and annualize it, and that's 24%. Now, you aren't going to do this every month and get this perfect setup, but it's just showing you the power of this. Now, we have courses, of course, in our newsletter where we want to teach you, just as like I'm doing here. I'm giving you 100% beef right now. So, but, you aren't going to leave this 1-hour webinar and be a pro at this, but, it's a fantastic start for you to start paper trading these on your own holdings. But Greg and I also have a consulting arm where we offer these option layover services to your stocks. So if you don't want to watch Netflix every day, and our hedge funds don't, and we might have Mrs. Smith, who inherited 100,000 shares of Johnson & Johnson, she surely doesn't want to watch the charts. Well, we do it for you. And this is what I'm reviewing with you right now is what we do for them. And so if that interested you, feel free to shoot us an email, and you can read about that service on our website. The spiders here, and this is, so we had a bearish gap after a breakout failure, and in our Market Edge advisory letter, master technician Greg was all over, not only near the end of this run because of the extended monthly charts, but once we got, and then on this day, he said, uh-oh, this might be a breakout bar failure. Once we got this gap down, if you were a subscriber to any of our 2 advisory letters, we were shorting the heck out of that. And then, when the pain came on this low and this low, we're doing the opposite. We're selling put spreads, which I'm going to review after we're done with covered calls. But these two blue arrows is when, if you were holding the SPY, which is the S&P 500 ETF, you would be selling out of the money calls, just like we reviewed in those other examples. Just a few more examples here. This one, I'm not going to even give you numbers. Facebook had a breakout, inside bar, bearish gap. Boom, that's your time to do it. Rallied up to resistance, rallied up to resistance, then bearish gap down. That is the time. Short your out of the money calls right at this red line. And you can see it just, tanked from there. Google, bearish gap down. You could, as soon, since it couldn't rally a 30-minute low, we're selling out of the money calls. It came back up to the resistance area, ugly red bar, but it still had an impressive retracement. We would do it, but only for a week or two. Came back up, going sideways. Now on this bearish engulfing, this is a topping pattern that we teach. And I just put a nice little square around these so you know which blue one I'm giving you the quotes on. So this star right here, the stock was at 1134. You just look for resistance. So I'm just going right to the 1180 and saying, I will agree to sell you my shares at 1180. And however the many days expiration it was, putting in $10.60 a share into my pocket. Baidu, I'm just marking these. You can check them out, later. We got declining 20 and 50 over here, and rally that failed. Here, it was trying to recover, but then a bearish gap. Here, the whole market was kind of right around the same time, topping out with the spiders. Wide range bar breakdown, inside bar, anywhere in here you could do it. Gap down, do it some more. At this star, just look how far out of the money I'm agreeing to sell the stock at 270. So even if you, just like all the other examples, even if you did agree to sell it at 270, you're still getting, the premium is yours to keep from day one, which in this example is over 1%, over 12%, over 13% a year right here. But if you're selling it at 270 and it's currently trading at 253, that's still $17 higher. Selling call options. So yeah, Ash is asking, selling call options naked, requires huge margin. Yeah, we're going to actually cover that in the next section. So far, we're just talking about selling call options on stock you own. But if you did sell a call or put naked, I'll just give you the quick answer. It's roughly 20% of the strike price. So it's still significantly less than trading on margin with stock, which is 2 to 1, which is 50%. But yeah, we're actually going to cover that very shortly. This is United Airlines. This is a stock, a chart I put together a while ago, but I'm just showing it to you because this is what we teach you to do on your own. And, again, we do it for our clients. But just assume you bought 1,000 shares down here on this breakout. Just like I've been showing you in these other patterns, we're waiting for one of those pictures of reversal, and we're selling an out of the money call. So here's one on United we did, and we did it just 2 consecutive months. So on A here, and this is, just for you accountants, and I think it just nicely shows the math of this. So when you buy 1,000 shares here, $57,000, $230 are coming out of your brokerage account. And then, ignoring margin. On A here, we're selling the out of the money. And look, just eyeball this. The stock's at $75. We sold a strike price $3 higher. For 28 days, we took in $1.42 a share. So on 1,000 shares, you sell a 10 lot, $1,420 just went into your account. And your CPA will handle this part. Your CPA is going to say, well, then that money you took in is not taxable, but it reduces your cost basis. And that's what this is, adjusted basis. So instead of UAL costing you $57.23 a share, now it's only cost you $55.81 a share. Hey, that was fun. Let's do it again. Okay, here we are at B. Came up to resistance. It just can't get through it. And, the sector was starting to sell off. We did it again. And this was just coincidence. We sold, the same 78, roughly the same time. We took in $1.90 a share this time. So in 2 months, we've lowered our cost basis, $3,300 in 33.20, 5.8%. Now, I know these examples are all, great ones, and you don't get this high percent every month, but it just should jump out at you. It's like, oh my God, I own something and I can put money in my pocket and use the charts and determine when momentum is slowed, and I don't think it's going up to that high level. That's what selling covered calls is. And so that is legging into it. All right, a couple more things, and then we're going to get into selling credit spreads. Selecting the proper strike and expiration. What strike price? I've shown you in the charts which ones we teach, but you want to sell them at or over resistance. The further OTM means out of the money gives you more cushion, meaning if the stock, bounce, because remember, we just want these to expire worthless for our full profit. And, we get into this in more detail in our course. But the further away you're agreeing to sell your stock, the less the call buyer is going to pay you for that right. And you saw that on the quote screens that I showed you. What's the best expiration? The sweet spot is 0 to 45 days. Go back and look at that time decay curve. I know I said 30 days or less, but the 45 is fine also if you don't want to be as active. And then remember, I showed you the red star versus the blue one. How confident I am in the short-term reversal also dictates how far out I go. It's going to depend on the bullishness of the pattern, volatility. We aren't getting into that today. The time decay, premium, how active you are. So yeah, we can't cover all these, but that's what we get into when we teach you what's the best strike and expiration. A few other points here, and then we're going to move on to spreads. So some considerations in managing them. Once you're in it, so you've seen these charts above, you're like, yep, I see it, I'm in it. Now what do I do? You've given somebody the right to buy your merchandise, right? That's what we started with. If you don't mind selling your merchandise at that price, because remember, it's a higher strike price and you've already put money in your pocket, then you don't have to do anything. But on here, so the goal is you want it to expire worthless, and we use the charts to give us that confidence that that's going to happen, because we want it, expiring worthless is 100%. So here's what I was starting to talk about. If you're happy with the return, then you can just let it be assigned, which means the call buyer is buying your merchandise at the agreed upon price, and your stock disappears and you're on to the next trade. If you don't want your stock taken away and you're a more active trader, you can close the short call. And what that means is, when you sold the call, you're giving the call buyer the right to buy it. But if you go back to the marketplace and buy that contract back, then you don't have to sell your stock anymore. Now, whether you buy it back at what price is going to be determined by where the stock is, how many days to expiration, etc. But keep this in mind. Even if you have to buy it back at a higher price, you have not lost money. So think about that. And I started with that, but I need to reinforce it. Selling covered calls is always profitable. Now, again, let me clarify that. I don't want, somebody to sell a call and then what I'm saying is you're putting money in your pocket, giving somebody the right to buy it. By lowering your cost basis, that makes it a higher probability of profit than if you did nothing and didn't sell the call option. And remember, I mentioned earlier, the only downside is possibly capping your gains. But if you see the math on these examples that we went through, the additional return that you made, even if it is assigned, is staggeringly greater. So only a fool would say, nope, I'm not, I don't want to agree to, to give up my merchandise at that price. Just go back and look at all the examples that we just went over. And those are novice traders that don't understand the power of what we're reviewing here together today. The time frame you use to determine when you think it's a short-term topping or reversal pattern is also going to change depending on which chart you're taking your signals off of. Do you want the daily to be a top, the weekly to be a top, monthly to be a top? And that all is dictated by your trading plan. And, discuss with your CPA the tax ramifications. I don't want anybody mad that's holding Procter & Gamble for 10 years and then letting the stock get assigned and then having a big long-term capital gain. I don't want that email. But, there's ways of handling that. Now, let's jump into the segue of everything you kind of just learned right here assumed you already own the stock. Now, I'm going to show you how to take that identical approach and make money by using the same short-term reversal patterns, but without owning the underlying stock. So let's continue. Start basic. The only movement of stocks, up, down, uptrend, downtrend, sideways trend. Fine, got it. So on these credit spreads, we're going to place a bet by using options, just betting that we either have a short-term top or bottom. And in all these examples so far, I've only showed you short-term tops. Why? Because you are bullish on the position. You own it. So that is generating income on positions you already own. What I'm getting into now is you don't own anything. You just want to make money like we do every day in selling these spreads. On a master trader bullish pattern, so that would be an uptrend or sideways trend, pull back to support. We're going to sell a bull put credit spread. I'm going to show you examples, don't worry. Master trader bearish pattern. We're going to use these in downtrends or sideways trends where it rallies and reverses at resistance. We're going to sell a bear call credit spread. And you can see just the way the stocks move on the bullish patterns. As long as it continues to go up, as long as it continues to go sideways, we profit. And it can even go against you all the way down to your break-even point, and you still make money. On the bear call credit spreads, as long as it continues down, as long as it continues sideways, or it can even go up a little bit to our break-even. And we make money because of the time decay that we went over earlier. We are selling options. The buyer buying these options, it's a melting ice cube. And that's what we're profiting from. Just like an insurance company. So we're getting paid. The insurance company takes in premium, and sure, they have risk. But actuarially, just like the casino, they are the house. They are the winners. And yes, we stop out. I said we have 85 plus % success. I didn't say 100. If anybody tells you 100, then you should just keep walking because it's not true. But we have tremendous success, and you just, even if you win 85% of the time and you stop out 15% of the time, those 15% of the times we stop out are just paying, little fender benders. It's not the whole house burning down. So that, hope you got that analogy. This, I purposely just took the same example, shop. Same quotes, same chart, but now we don't own the stock. But I want to profit on this bearish pattern right here. So same quotes. Remember, we sold the 155s way the heck up here for, the midpoint, 340. And back to, Ash's question, or Ash, we don't want to sell this call naked, because remember when we sell a call, what we put money in our pocket, and we have to do what? We have to sell stock at 155 if the call buyer wants to buy it. That's what we just reviewed. But I don't own it in this case, Dan. That's right. You don't have to. That's why we then buy and further out of the money call. That's what this green box is. And that is what's called a bear call credit spread. Same entry, same price. We're going to short this 155. We're going to buy the 175, and we're going to load it up into our trading software as one order. And always try to get filled at the midpoint. And this midpoint is $2.75 a share. So if you sold a 10 lot of this bear call credit spread, $2,750 is immediately deposited into your account. Is that free money? No. You have an obligation to sell stock at 155 on or before expiration, which is, what did I say, 28 days? 29 days here. Look at the stock. We're using the charts to be our X-ray of we're at a short-term top. Let's look at the math here now. Your broker, for you to put on this trade, is going to require the difference of these two numbers, That's called the spread width. So it's 20 bucks less the money you put in your pocket, 275. You do the math there. I did it for you. That's 20.7% return on your capital for 29 days. That is 100% pure profit as long as at expiration in 29 days, it is below 155. The stock's at 116 right now on this chart. Do you think this is going to go to 155? I don't. But that doesn't matter because once we're in a trade, remember I told you we're just in trade management mode. So let's say, if I were in this trade, I would stop out of this bear call credit spread if it traded over 125-ish. But because of time decay, I'll let you count all these bars, but it looks like 20. So 20 of these 29 days has already expired. And it's so far out of the money that we've made the majority of this 275 gain. But that's our trade management aspect. Now, I'm going to show you how we do the exact same thing on bullish patterns. This is pretty much the other one upside down. So we're looking for bullish reversals, and then I'm going to sell a put underneath. And I'll define that in a moment when we look at the chart. So I'm going to sell a put. Then I'm going to buy a further out of the money put. I'm going to put this in as one order, a net credit that's going to hit my trading account immediately. And as long as the stock closes above this green line, which is the short strike price, 100% profit. Let's look at FL here. Everything master trader teaches and trades, whether it's trading stocks, commodities, currencies, or options, starts with a bias of the charts. Now, I know there's some option traders out there that they don't believe in charts. They think chart reading is a coin flip, and we kind of just laugh at that, saying, well, it's at your own risk, because why else would we have 85% plus success rate? So we start with what's the pattern? Master trader, bullish continuation. We have a nice rounded bottom, chopping around. Now, we aren't going to get into it now, of course, but, we have directional trades where we're expecting a big move. And then these credit spreads, we just put under the category of income trade. So that's what you see here, strategy. It's an income trade. Why do I call it that? Because I'm just putting money in my pocket, predicting a short-term support, a turn. In this one, we teach it in the course, implied volatility. The higher the volatility, the more we get paid for putting on these trades. So we love high implied volatility, not only of an individual stock, but we like implied volatility of the market. So of the spiders, the SPY, when we get sell-offs, we clean up. And those last two sell-offs that I showed you on the spider chart, we had multiple bull put credit spreads going on. And a beautiful thing that exists in the SPY, they have expirations at least three times a week. Monday, Wednesday, Friday, and sometimes on Thursday, if it's a quarterly. So we get paid just for predicting a 1 or 2 or 3 or 4. It's up, how it's up to you. Bottom or top in the spiders, and we just keep collecting these credits over and over and over again, and that's the monthly income that I'm talking about. But let's continue with this example. So we're in this example, we're selling a $40 put. What does selling a put mean? It means I'm putting money in my pocket, and the put buyer has the right to make me buy his merchandise if he forces me to. Okay, so it's just the opposite of the calls. So in the selling the calls, I'm forced to sell it, the merchandise. In selling a put, I'm forced to buy merchandise. But we use charts to tell us when the odds of success are staggeringly stacked in our favor. So pity the option traders who don't use charts in their analysis. We run circles around them. So we're selling this $40 put way the heck, look, $9 away from the current price, 9 and change, on support here. And then we're simultaneously buying the $35 put, and that's what's called a bull put credit spread. We took in 55 cents a share. So when it's selling a 10 lot, that's $550. How much does my broker want for this luxury of putting on this trade? $4.45 a share, 12.3% ROI, return on capital, 29 days, and 18 plus percent cushion. Cushion meaning the stock can fall. Now, see, if I told you this in an advertisement, I'd say, hey, come to my webinar and I'm going to show you how a stock can fall 18% and you still make your maximum gain. You would say, yeah, right, snake oil salesman. I think I'm going to go for a bike ride instead. But I'm showing you examples. And come take a trial to our Market Edge advisory letter and watch us do this in real time. We just opened a what we're calling the Master Trader Green Room, where it's live market commentary and interaction with our subscribers at the market open and close during the busy hours, and we're interacting with them all day, putting on these trades, showing them how we're in management mode, looking at the market, looking for new opportunity, giving them lessons, answering their questions on stocks. All right, so our break even, if we're required to buy this at $40, what's my cost basis? Well, I've agreed to buy it at 40. I've already put 55 cents a share in my pocket. So that's $39.45 is my cost basis. Now, again, I'm just talking about spreads here in our, could you do this, just sell this naked? Sure. And we, in our full option strategy series, we get into the nuances of that. So we're just covering these spreads here now. Recap. Let's see what you've learned so far. So we've been talking here for 50 minutes. I've just shown you part of the exact system that I've been using for decades of how we have this batting average of selling options around reversal patterns, whether you own the stock or an income trade for new opportunity. The edge is in selling them around the patterns for maximum returns. Option sellers, because of time decay, is what's stacking the odds in our favor. We're using patterns to sell covered calls, and that's called legging into it. I mean, you could do a covered call right out of the gate, but then you're buying stock because you're bullish, but then you're simultaneously agreeing to let somebody, buy it from you. And there's nothing wrong with that, but what I've just shown you in these slides is superior if you know how to read charts, and as I've just shown you, because then you're waiting for the stock to advance, then and waiting for the stock to get tired. I like using simple language. Momentum is slowed. The stock's tired. and then you sell your call against your stock. And then credit spreads. We're just using these reversal patterns. So when we buy stock or put on a directional trade, we want the pattern to be pretty confident on multiple time frames. But these credit spreads are so easy to put on in any market environment because we have all we're doing is calling a bottom. I don't care what you do, stock, just don't violate my short strike. And that's why, we love them so much. And then many examples both of legging into covered calls, and I've just shown you just 2 examples on the credit spreads. So, if you left the webinar right now, I've shown you the beef. You could start generating this additional passive income as an investor or a trader using the information that I've just shown you. Start slow, of course, paper trade, but I've shown you some good stuff there. But if you're serious about wanting to take it to the next level on these selling these credit spreads, again, you're getting paid to predict where a stock will not go. I showed you some of those patterns. Easier to trade than stocks, generating your monthly income. I've shown you the cushion, higher probability in this course. It's 5 detailed modules that we're going to go over the basics, more of option pricing, what a call and a put is, the patterns, of course, many more examples, the management of these, and then, whole chapter on learning how to do this just on the S&P 500 on the spiders. So please check out the description, and you can order it for $97. Here's mastertrader.com, spread details. We've had many, I've literally gotten dozens of emails saying, I'm not going to sit here and just brag, but they're saying that was just phenomenal. $97. This is a very easy option strategy. Thanks, William. But I'm not going to force something on anybody that it doesn't meet their comfort zone. It has to be a strategy that you love, like I do. So I want to address just a couple questions from people in the past. So this question is on covered calls. Why would I want to sell calls on my investments and cap my gains? Well, the person who asked that obviously didn't sit through this webinar, because everyone who's in this webinar right now should be thinking to themselves, hello, that's a stupid question, because we're using charts to determine the timing when the stock's slowed momentum and we're selling it out of the money, and we can still manage it in between. And it is impossible to lose money selling the call. I'm not saying your stock can't tank, but you own the stock in any event. I didn't put you in the position. I'm just telling you when to sell calls to turbocharge your returns. Selling a call on anything you own, you cannot lose money. You're putting money in your pocket. So I know I'm kind of repeating myself, but go back and look at those examples. All you're doing is possibly capping them, but our charts are telling us that it's a low probability of capping them. And then, when we get into the management more in the course, you'll see how you can, adjust for that. So this one applies to either strategy. I have a full-time job, so I'm concerned about the time commitment. Folks, you determine how active you want to be with this. I have some people who do not open up the computer all week long. They get some lemonade on a nice Sunday afternoon, whatever, 1 o'clock, and they go through, their trading plan. And this could be 10 minutes a week. It could be 10 minutes a day. It could be 10 minutes a month. So time of just monitoring the patterns and when to put these on does not take a lot of time. Then you put your stop in and then you're off. But, we're active traders. So Greg and I obviously are looking at them every night. And then Greg is a scanning machine. He's like, a little, what's the word? Not a little puppet. I'm trying to think. I can just say, Greg, perform, put on an act, find us some trades. And I promise you, he can find trades in 20 seconds. So, and he obviously agrees, finding these credit spreads are so easy. All right, let me continue. I only have a $5,000 account. Is that enough? Yeah, it's $2,000 is enough. You just start small with one contract. If you sell a $5 wide or even a $3 wide spread, and let's say you take in, 30 cents, then the margin required on a one lot is $270. So no, the account size is a misnomer for selling credit spreads. Credit spreads do not take a lot of capital, and you just do one contract at a time until you build your confidence and your account size. Does it make sense to risk such a large potential loss in spreads for the limited gain? The answer is absolutely. Think of the insurance company, because it's identical. You have to focus on probabilities and likelihood of gain and loss. Why would Liberty Mutual sell me a car insurance, for $1,000, let's say, when they're on the hook for, $300,000? It's identical. They're doing it because of probabilities. Yes, they're going to have to pay some claims out of their accumulated gains, but you can't look at the maximum loss. You have to look at the likely loss. And the research we've done based upon the Master Trader Strategies and Management Method is because we stop out of these, when they aren't going as planned. So we don't just stay in them in hope mode and roll them forever like some people do. We just cut the loss, move on to the next opportunity. So on average, our loss is twice the amount of the premium received. So sure, we have little losses, but all the little gains should outweigh it. Now, the little gifts I promised you. I'm giving you two gifts right now. This one, so you're going to have to write down this URL. This one is focusing on the covered calls. So it's a great free ebook, and everything that we just covered in the first part of this on covered calls is in there, but I'm more lively, of course, being on a webinar. But pick up the book if you want to learn to cover calls, and it covers many more things too. And I'm giving you this because you're here and we're nice and we want to help you. But this other one that I promised you, this is the title of it. Selling and generating monthly income, selling credit spreads with charts. Now, unfortunately, I wanted it done today so I could give you a link and download it. And I'm not baiting and switching in you because I'm not, this is a gift. There's no strings attached other than you have to email it to me because our ebook compiling guy didn't get it done today. He'll get it done over the weekend. So send me your email if you want this credit spread book. And that's talking about more about those last two slides. And it's a great ebook. I mean, again, there's beef in there. We don't bait and switch or, say, oh, we got all these proprietary indicators, this and that. That's not our style. But do yourself a favor. Get all our free books, sign up for our free chart of the week. We're on YouTube. Greg and I do videos. He does more. Check out our free our 7-day trial to our advisory letter. But also these credit spreads are really one of our best income, easy to find and trade strategies. Invest $97. I haven't had one disgruntled customer, just all compliments. And master one trade. And then when you see how much you love it, then you can look into mastering stock and option trading the master trader way in greater detail. This one, Tony, the covered call. This is a covered call book, and this one's there now. So there it is. But I don't have a link for the credit spread because it's not, the text is done, but he's trying to put it all together pretty for you. Perfect. So in closing, we thank you for attending. Greg and I are always here to help anybody in the Master Trader family. I mean, we even if you're not, we like helping fellow traders. Feel free to email Greg at mastertrader.com, me, Dan at mastertrader.com, and we will look forward to you trying out some of these things and your continued or start of great success. Hey, gee, thanks, my friend.